All right, welcome everyone. For those of you that might be new here, I'm Ron Bullis, the CEO and co-founder of Lifeworks Advisors. Dressed a little more casually today than maybe I have been in previous live streams. My wife and I are in the early stages of a massive, oh no audio, hang on Lex. All right, can you guys hear my audio okay now? Josh, can you hear my audio? All right, let's do this real quick. If everybody can hear my audio, down on the bottom menu bar, there is a little smiley face that has emoji reactions to it. Click on that and give me a smiley face, thumbs up, hand clap, something like that if you hear my audio. Awesome. Good afternoon, everybody. I'm Ron Bullis, the CEO and co-founder of Lifeworks Advisors. Want to welcome you to another one of our educational live streams. Josh Bennett, one of our partners and head of strategic relationships, is going to be doing most of today's presentation. I was saying I'm dressed a little more casually today than maybe I am normally on our live streams. My wife and I just started a couple of weeks ago a massive renovation project on our house. And if anybody's ever been through that or is a builder, maybe on the builder side, you have a different perspective, but our house is missing all of its windows. Most of them are boarded up. We were not quite prepared to have a dust storm roll through our house from some heavy winds. And so everything's buried in plastic and life is a little chaotic. So hence no iron shirt today and a little bit more casual than normal. Anyway, really excited to be here. I'm going to turn it over to Josh Bennett, again, a partner, senior advisor here at Lifeworks, one of our key members of our investment team, to present some of the stuff about the market. What we've been doing on our past webinars is we've been bringing together information about the market and a topic. If you're new to Lifeworks, Lifeworks follows a quarterly planning calendar for our clients, meaning every quarter of every year we have a specific focus, and each of those quarters we generally are covering one or two key topics that relate to your wealth management. Q2, our focus as a firm is on two of everybody's favorite topics, taxes and risk management. So this is going to be the last monthly webinar where we're mixing a economic and market update and a planning content or a planning concept. What we're going to do is we're actually going to break those apart, still offer those live streams monthly, but it'll give you the ability, if you want to just jump in and catch up on what's going on in the markets, economic news, et cetera, you can do that. And then if you want to stay or jump into any of our educational content about a specific planning topic, you can do that as well. But we're going to make it so that you can pick and choose there. So today, when Josh is done with his presentation, stick around. I'm going to walk through a couple of topics around risk management, not talking about insurance, but specifically an area of risk management that if you've been a client for a couple of years, you've heard me talk about this numerous times. I've had a few guests on. I'm going to do a short 10-minute presentation and talk about digital privacy and cybersecurity and why we as a firm believe this is probably one of the most important areas of risk management that oftentimes gets overlooked. So I'm going to do a short presentation on that. We have a white paper coming out probably in the next 2 weeks, so sometime yet here in Q2, covering specific things and updates around cybersecurity, hacking attempts, scammers, digital privacy, as well as we'll be doing another webinar specifically on that and going a little bit deeper. So welcome. I'm going to turn it over to Josh, and he's going to lead us through some of the key topics that our team's been talking about. Every day there's some interesting news, but he's going to take us through some key economic topics, some things going on in the market, and then I'll add a little color commentary, and at the end I plan to talk for a few minutes about risk management. So welcome everybody, and welcome Josh Bennett, one of our partner advisors and members of our investment team.
Thank you for the intro, Ron. Great to be here, and good to see everybody here. And yeah, as everyone may know, it's been a really quiet month or two in the economy, so we shouldn't have much to talk about. Just kidding. Quite a few things going on that I think will have a lot of different implications, and if nothing else, will be sort of interesting to watch as we see things develop. Let me get my screen shared here. I'm assuming everyone can hear me all right, right? Let me know in the chat if not. And can everyone see my screen now? All right, perfect. All right. So like Ron said, we're going to kind of dive into economic news and what's going on in the markets. And then Ron will come back on and kind of talk about what's going on with cybersecurity and some ways to protect yourself. So diving in, a lot of interesting news and stuff going on, especially with the economy and Trump and everything that's been done with the tariffs recently. So if you haven't seen what's been going on just back and forth in the news, obviously, Trump instigated tariffs pretty much across the board and then, sort of quickly repealed those and is in the process of essentially letting countries come to him for negotiations to sort of peel those back. That being said, the big one that has not been repealed is China. So Trump has basically instilled a 125% reciprocal tariff with China, and it's up to 245% on certain goods. And this has sort of created a tit for tat with China, which we'll ultimately see. We're already starting to see some implications of that and what's going to happen with rising prices and stuff that we'll get into more here in a minute. But as of right now, across the board, most tariffs, except for a 10% baseline reciprocal tariff against countries, have been repealed or at least paused for the time being, just waiting on those specific trade negotiations. But China is obviously the big one that has some pretty large impacts, especially on the prices of things in the U.S., which that has not been paused at this moment. Another big thing that has been in the news recently that has a pretty large impact, and I'm actually going to talk a lot about this as we talk about the economy, is what's going on between Trump and the Fed. So the Federal Reserve has been kind of put into a very curious predicament, we'll say, with everything that's going on in the economy. So the Federal Reserve controls interest rates, controls, buying and selling of bonds and things to essentially control inflation, right? Well, the tariffs that have been issued are a thing that can cause inflation, just because tariffs, we talked about in a previous webinar a couple months ago, tariffs essentially raise the prices of things, with the idea being that it makes the U.S. goods more competitive worldwide. But that being said, it's essentially a tax that increases the prices of goods, and that all gets passed through to the consumer. Well, Trump has been basically pushing the Federal Reserve to lower interest rates. Well, when you lower interest rates, it essentially stimulates an economy. Well, stimulating an economy can basically put too much money back into the economy, and this is kind of what we saw during COVID, is a lot of money floods the markets and you get inflation. So we have kind of these two different variables that could be impacting inflation right now, from both Trump's push for the Federal Reserve plus tariffs, and the Federal Reserve historically has been a institution that has remained independent for the specific reason of wanting to impact the economy in a positive way without the puppet strings from the government, right? Well, Trump has been going on Twitter and his social media platform, basically saying, I want, Powell out. I want, interest rates lower immediately. So they're essentially trying to reset the Federal Reserve Board, which could have pretty drastic implications on the independence of the Federal Reserve, as well as, how the resulting economic impacts of all these tariffs and what's happening on the government half of the equation, how the Federal Reserve reacts to those different things, which could have ripple effects through our economy in a bunch of various different ways. And a lot of this is stuff that is very, for lack of a better term, experimental at this point, because there's a lot of factors that we have seen in bits and pieces throughout history, but never in kind of the same combination that we're seeing today. So kind of like I mentioned, tariffs plus low rates equals inflation, right? So either one of those variables can equal inflation, but seeing them together could have some pretty massive impacts. And one of the worries is if Trump is basically putting pressure on the Federal Reserve to lower rates when we're getting inflation from tariffs, that could cause some pretty drastic impacts. Another thing that we're seeing that could tie in, we're going to talk about currencies and stuff here in just a second, But one other thing that we're seeing a lot of that has a pretty big implication on what the Federal Reserve does is other countries, because of these tariffs, selling U.S. treasuries globally. So what happens oftentimes if countries' currencies come under pressure against the U.S. dollar to essentially protect their currencies or just as a retaliatory measure, they may sell U.S. bonds, right? Well, if U.S. bonds are getting sold globally, that lowers U.S. bond prices and increases yields. So therefore, when the U.S. government needs to go borrow more money to make it competitive out in the market, they have to have it at higher rates. And so we could see basically the hands tied to increase rates just so that way people are still buying our debt, right? So it creates a bunch of very contradictory forces in the environment right now, which are going to be, I mean, no one has a crystal ball in terms of seeing how these things are all going to play out. But there's definitely some interesting stories that are coming to fruition as we're watching the markets, and things that we're going to need to keep a close eye on. And this is all happening at a time where inflation was relatively stabilizing. So we were getting down to historic long-term averages of where the Federal Reserve wants to keep inflation, which is ultimately why they've been slowly ticking down interest rates over the past year or so. But this could all get, again, fairly destabilized based on what's happening now with tariffs and U.S. treasuries and currencies globally. That being said, as of right now, at least according to probabilities, there's still a very low risk of recession. Obviously, anything can change at any point. But I think it's worth noting that a lot of the variables that typically, quote unquote, trigger recessions are still at pretty historically low probabilities. So there's still good things going on in the markets and the environments, despite kind of what the news headlines say. But I think something that's really interesting along the lines of inflation and kind of the global economics that's really worth drawing attention to is what's going on with the currency markets, and especially in relation to the tariffs. So this is a chart of the U.S. dollar compared to the Japanese yen. So the yen is typically a currency that's like a safe haven, if you will. It's just been historically very stable. But something that we're also seeing, though, is as these tariffs have come out, basically a lot of the global currencies have been depreciating to the dollar, which actually has a counteractive effect. So when US dollar becomes stronger, obviously it's more expensive to buy US goods. So the whole point of Trump's tariffs was basically to make US goods more competitive worldwide. So therefore, we would reset those trade imbalances. At least that's kind of the ultimate goal was to get other countries to buy more U.S. goods. Well, now what's happened in relation to a lot of these currencies is that it's actually becoming harder to then buy U.S. goods because the U.S. dollar is depreciating, and that's also why we're seeing so Japan was one of the for lack of a better term, biggest culprits over the past couple of weeks, and I'm going to kind of show this more in a couple of slides, but when we started getting all this volatility during all these announcements of tariffs, Japan was basically selling a lot of U.S. bonds to basically protect their currency from this sort of devaluation, right? So we're starting to see this more and more, but this is something that we want to keep a close eye on. This is also happening with the euro. So we're seeing the euro. The interesting one is actually what's happening with the yuan, like the Chinese yuan compared to US dollar. It's sort of just mostly been stable, but just kind of all over the place. Just pretty much anytime a different news article comes out, it'll be super volatile. But so we haven't seen much movement one way or another in any kind of confirming direction. And this kind of helps highlight the tit for tat thing that's going on between US and China. Because right now, the global markets are basically saying we have no idea which way this is going to go, which is fairly interesting. But this is something that we're going to be kind of keeping a close eye on because it does have a pretty massive impact both on, internal planning with, how inflation is going to impact your plan, how it's going to impact investments, how it's going to impact companies. Just because, again, if U.S. goods are harder to purchase or more expensive to purchase. It could have impacts on bottom lines of companies. There's all sorts of variables that could come into play here, as well as like the currency markets, just in terms of companies trying to balance out all this volatility. So, for example, if I'm a U.S. company and I'm trying to either import or export with Japan, well, when the currency is going all over the place, if I'm trying to create a deal for 6 months from now to ship goods one way or the other, that's very unpredictable. So you have to use futures markets and different foreign market or foreign exchange markets to basically control your currency predictions. And so all these things are going to have pretty large impacts on essentially what's going on in the economy. I see Ron's been poking some questions in here. Well, I'll pause there and see if what questions people have just on the economy before we dive into markets.
Yeah, you were good, Josh. I was just fielding a few questions, which I normally don't get to do while somebody else is talking. So I was enjoying the change of pace for a minute there. But one of the questions that's probably worth just stopping on, and it wasn't a question. So Jeff asked, how do we protect our accounts from de-dollarization? I think that it's worth maybe pausing just a second and calling out what this is. So my understanding, Jeff, of kind of what you're pointing out is something I have read a fair amount about and spent, I don't know, maybe the last 6 or 7 years talking about, which is the status of the US dollar as the reserve currency for the world, right? The petrodollar being one example. Most all oil contracts until recently are settled in US dollars. Your Euro bonds, interestingly enough, are US dollars. They're US dollar denominated bonds or debt that are held by foreign banks and sovereign wealth funds, et cetera. So the use of the US dollar essentially as the reserve currency for settling trades, for pegging the value of debt between companies and between countries and between sovereign banks is still very, very strong, meaning I think something like 80% still today, even after all the tariffs and kind of the turmoil and let's say the loud brashness of how our government right now is maybe going about it. This isn't a political conversation, by the way. We're just talking about reality. There's still a significant use of the dollar across the board. And the biggest reason for that is the same reason why the US right now can save a rattle about tariffs. And a lot of countries are going to still come to the table and negotiate favorable trade deals for the US because the US economy, our consumer economy, is the largest in the world by magnitudes. So the vast majority of countries that export goods and services want to sell into our market. To be able to sell into our market, in fact, we might be their only market, by the way, but to sell into our market, they have to exchange their currency for dollars and settle the trades in dollars, right? So there's a lot of conversation about Bitcoin or crypto becoming the future global reserve currency. That's probably for another long form discussion. But there is some geopolitical worry, and there is a lot of commentators out there talking about the end of the US dollar dominance. And I would say until another superpower emerges with a larger consumer-based economy than the US and a larger military, the dominance of the dollar is likely to continue, regardless of whether it's a Republican in office or a Democrat in office or something somewhere in between. So I think it's an interesting thing to talk about. And Josh, what are your, kind of what, I know you and I have talked about this before at length, but, what would maybe you add to that, if anything?
Yeah, I would say it's definitely a risk that's out there, especially with, over the past couple of years, there's been the conversations with one of the biggest things that stabilizes the US dollar globally is the trading of oil, like the petrodollar Ron mentioned. That is a big sustaining factor in terms of the value of the dollar, which the BRIC nations have sort of tried to move away from that. But yeah, I think right now, the bigger risk to the US dollar would be countries unloading U.S. treasuries and creating impacts to the U.S. dollar that way, as opposed to, abandoning it. But I think that's more of a question on less about the U.S. dollar and more about the government's ability to pay back the debt owed. But, globally, the U.S. dollar is still the strongest currency out there. So even it's the most dominant currency
By
out there.
magnitudes. Yeah.
Yeah, but like it's just hard to put in comparison. Like the Chinese yuan is probably, is one considered that could take it over just because of, the Chinese military might and just sheer number of people, but it just still pales in comparison to just the magnitudes of use worldwide. So it's a long way off from that truly happening, in my opinion. But I mean, there is definitely the concern of, weakness in the dollar or something happening due to, just people unloading U.S. treasuries worldwide. But again, I think especially if there's a strong U.S. dollar, people like getting paid in U.S. dollars. And so it's one of those things that offers a nice counterbalance to some of those other risks.
So the questions, the answer that I posted in here too, if everybody wasn't looking at the chat, and this is, Ron's opinion and probably shared by the Lifeworks investment team. One of the best hedges against poor fiscal policy or the potential for the U.S. dollar not being the reserve currency is, interestingly enough, U.S. publicly traded equities. So if you look at the top 500 companies, right, the S&P 500, and you look at the percentage of the business that they do outside of the U.S. and the number of storefronts and facilities and manufacturing places they have outside of the U.S., right, most of them are, 60-40, 50-50 in terms of like how much of their business happens overseas versus here. So they're already doing things that it's really difficult, I think, for the individual to do. They're doing currency swap hedges. They're doing futures on currencies. They're doing business and holding assets in other foreign currencies and foreign markets. And so by proxy, right, if we own a basket of quality U.S. equities, we are already getting a group of institutions that are doing some of that work and trying to think about how they navigate that and at the same time still turn a profit. The alternative here too, I had a long form argument at an industry conference a few years back about, the use of, say, cryptocurrency, specifically Bitcoin, right, in this scenario. And I said, look, if you are a US-based citizen and you live in the US, heck, if you're a US citizen, even if you don't live in the US, the IRS is going to come looking for their taxes. And right now, the only form of payment for taxes that the IRS accepts is the dollar, right? So I don't think we're in a capital controlled, kind of situation like China is, where they limit how people can take money out of the country and what they can own, which, by the way, is why they've bought so much real estate in Canada and the US and different places like this. But the point here being that when we think about protecting our accounts from this, we have to look at what the real risk is and then also what the possibilities are. So if we want to renounce our citizenship and try and take all of our assets when we leave the country, there's an entire webinar I could do on that. It's actually pretty difficult to do. But the US is still going to require payment of their taxes in dollars. So even if the value of the dollar falls and we build some type of hedge, I'm not saying we would, but even if we hypothetically did, we would still have to sell those other assets that we've been using as a hedge to create dollars. So they would still force us back into the dollar market, right? We would still be denominating our investment accounts and our physical wealth into dollars of some format to pay taxes. So this isn't gloom and doom. There is a lot of people online, gold bugs, cryptocurrency advocates, people that predict the end of American dominance. There are macroeconomists. Harry Dent is an example of somebody who's been predicting the doom cycles forever. People get really rich selling books and podcasts and creating followings off of that. But in my opinion, if you look at the historical track record, at least for America, the doom narrative doesn't hold when you look at history. Now, maybe if we look at 5,000 years or 10,000 years and include all of, human civilization, yeah, clearly, Rome, Greece, other significant empires have collapsed under the weight of their debt, right? But in terms of how do we protect our accounts from de-dollarization, own, as we do for our clients, a basket of large cap US publicly traded equities that are healthy, right, that are screened for things like profitability and low volatility, right? Some of the factors that we use. I think that's probably one of the best ways to hedge against that. But great question, good conversation. I don't want to get us too far down the rabbit hole because we could probably spend an hour talking about just this very thing. So
yeah, and I think one interesting kind of tidbit on this too, is just to like understand how globally integrated a lot of U.S. public companies are now. Like one of the best measures of inflation for global inflation in all different currencies is actually one of the things called the Big Mac Index, which basically measures the price
Yeah.
of the inputs and the final product of a Big Mac globally. So I think that's one of the most interesting things is like one of the biggest, your closest identifiers of inflation is an index that just tracks McDonald's worldwide. So that kind of gives you an idea of how globally integrated some of these companies are. But anyways, onto the markets. So obviously there's been a lot of turmoil in the markets as of recently, especially when it comes to the NASDAQ, which is primarily tech-weighted companies. So we've seen a pretty big hit to the NASDAQ, some hit to the S&P 500, as well as like small caps and stuff as well. So across the board, the ex-US has actually done fairly well. The S&P 500, it's actually boosted back up a little bit since I pulled this graph, but basically it's down about 10% right now year to date, whereas NASDAQ is down 17%, and then the Russell 2000, which is smaller companies in the next 2,000 companies, so it includes a lot more smaller, more volatile companies, that's down about 15%. Again, these have rebounded a little bit since I pulled this, but gives you at least an idea of where we're at year to date. One interesting thing that, and this kind of goes back to the Treasury conversation I was having a minute ago with the economy, but one thing that I think is really important to understand with what's going on right now, and this is something that we saw a little bit I think it was about 2 years ago, maybe a year ago, but something we could see a lot more of going forward is the correlation between bonds and stocks. So historically, and without getting too much in the weeds, we've had basically the 60-40 portfolio has been kind of the gold standard in diversification, right? You have 60% stock, 40% bonds. It was created by this, through this white paper, essentially, 60, 70 years ago at this point, that essentially said, hey, we can control the volatility in a portfolio by having two assets, one safe asset, one risky asset. And by just, lowering and increasing the variables, we can control the risk in our portfolio. And that's where the typical moderate portfolio was the 60-40 portfolio. And the idea here is that, when stocks go up, bonds, go down, and then bonds serve as a hedge when stocks, go down because one flows into bonds and it's a safe asset. That's been the assumption for, most of modern history, right? And it's a theory called modern portfolio theory. And that's what, I'd say 95% of wealth management is sort of based on. Well, what happens then if bonds no longer become a safe asset, which is something that I've argued for a while, but we saw again during the big volatility that we had a couple weeks ago when Trump officially announced all the tariffs and we saw some of the biggest market drops in history. Well, I thought the more interesting story that day was not the stock market drops, it was the Treasury market drops. So basically yields immediately started to increase in the Treasury markets. So also to kind of understand why yields increase. So what typically happens is you have basically yields so you have interest rates and you have prices, right? So as prices in the bond market go down, the yields on the bonds go up, right? So basically, if you ever hear someone said, hey, yields and bonds are going up, basically that means the actual bond prices are going down. So that's exactly what we saw as Treasury bond values were starting to go down pretty drastically as the same time the stock market was going down, right? So retirees or anyone that's in kind of this traditional 60-40 portfolio or some iteration of that essentially had no hedge to the market volatility that day. And I think that's a very important thing to understand, especially going into retirement, is like if you're planning on having this hedge against volatility and all of a sudden it disappears, that could cause pretty tremendous impacts on your overall plan, right? But this is something that we're likely to see a lot more of going forward. One, just because of the amount of leverage that's in our economy, but also just again, as countries are playing tit for tat, we have trillions of dollars in bonds worldwide. as we start playing this tit for tat game, or currencies become volatile, well, one play that other countries can do is liquidating and no longer buying U.S. bonds, which could, again, if they're selling bonds, it's going to push prices and bonds down, right? So this is something that could create, some problems for a lot of retirees going forward, and something I think that's very worth paying attention to. Another thing to note is, like, we've talked about this in a couple past conversations, but one of the big drivers of risk and volatility in the stock market lately has been just the concentration of the top 10 companies in the market, or even the top 7 companies, called the Mag 7 or Magnificent 7. Well, those 7 companies have been also a big driver of the market pullback. So, for example, Tesla went down about 41%. So much to the point where I think actually Elon Musk announced yesterday that he was backing off Doge and going back to essentially full-time CEO of Tesla. Nvidia is down about 26%, and then all varying pullbacks. But the S&P 500 again is down about 9.94. So you can see like that the biggest companies have been really what's been anchoring this down, whereas like the remaining 493 are actually fairly stable. And that's part of why we, again, use the quantitative metrics we use as Lifeworks to find companies that aren't susceptible to this kind of volatility. But I think something that's really worth noting is that these 7 tech companies are driving a lot of the losses that are in the stock market right now. And so just by simply avoiding that concentrated risk, you can do a lot to hedge your portfolio. Sorry, Ryan, I saw your questions here. Or maybe I think you're just answering questions. I'll pause there. Anybody have any questions too? That I'll keep rolling. All right. So another thing I think that's worth noting when it comes to markets is just keeping an eye on risk. Obviously Ron's going to be talking about cybersecurity risk, but when it comes to risk in the markets, obviously the bond market's one risk, or lack thereof. Lack of a hedge is a big risk in the markets right now. But something else that's worth noting is the CAPE ratio. So we've talked about this in the past. The CAPE ratio stands for cyclically adjusted price to earnings ratio. So how high is the stock market compared to the actual earnings of the underlying companies? So lately, we have been at some of the highest stock market valuations in history. So including like the 1929 crash, the tech bubble in the 2000s, and we had gotten basically the 3rd highest in history. Since, with basically just the 7 companies pulling back pretty drastically, we've actually seen the CAPE ratio pull back some. I mean, there's still a lot of risk in the markets in terms of how highly valued the market is relative just to the earnings, especially historically. But that being said, as we're seeing some of the concentration deflate from those 7 main companies, we're seeing the risks of the overall market start to pull back, which is a nice thing, because that also means, hopefully better future returns across the board. A couple other interesting stories that I think are worth pointing out in the markets is something that is still sort of seen globally as a safe haven, especially with all the currency chaos going on, as well as the equity market chaos, is gold prices, right? So we've seen gold pretty much on a tear for the past couple of years, but even as of late, we've seen gold essentially skyrocketing. And that's just due to the global uncertainty and people jumping into gold as basically a warm and fuzzy place to go when everything else seems pretty chaotic. So that's something that we could see continue to go up for the foreseeable future. One nice thing about gold, and this is something I'm going to talk about Bitcoin next, but one nice thing about gold and those kind of assets is that they're a finite resource. Right? There's never going to be more gold than already exists. And so when you have more and more currencies and money worldwide chasing a safe haven asset like gold, it just appreciates the value, right? So something we sort of expect to see go in the future. Obviously, no one has a crystal ball, but I think that's been very interesting to see just how much it's taken off over the past year just due to all the market uncertainty. Another interesting one is Bitcoin. I mean, Bitcoin, historically has a lot of similarities in terms of like the, value pitch to gold. Obviously, it's a digital version, but same kind of ideas of finite resource. There's never going to be more Bitcoin than has already been produced or already been coded in, I'll say. But a lot of the correlations with Bitcoin haven't actually transpired the way people would predict. So there's still a lot of correlation to tech and technology, which is where we saw, Bitcoin get very volatile, going from, up, record highs of over 100,000 back down to the 70s, was sort of in line with all the tech volatility that we saw. We saw a very similar pullback with Bitcoin there. But what's interesting now is that with the turmoils in the bond market and then turmoils just in the stock market, we've actually seen a pretty large bounce back in Bitcoin, more in line with what we would typically see in gold. So like Bitcoin, I think, is still finding its a place in asset allocations across the board. Some people are treating it as a safe haven. Some people are treating it as essentially a tech stock. Ultimately, we think the value pitch is still there for long term, but it's very interesting to still see in its infancy, how it's going to be adopted, overall. But right now, sitting back near all-time highs. All right, well, I'll pause there before Ron jumps into cybersecurity stuff, and see what questions people have on economy, markets, etc.
Yeah, so there was 2 good questions in there. And what we'll do is I'll tackle these questions with you, Josh, and then if anybody wants to, I'll real quickly here enable everyone to have mic access. So if you want to kick your mic on and ask a question, you can, or throw it in the chat. So first question that popped up in here is, how does the BRICS play into world economics? So I'll take a little stab at it. There's a lot that could be said, and then I'll let Josh maybe add his thoughts. Between the two of us, we're probably covering most of how Lifeworks sees this. So one of the things that I like to talk about both internally with our advisor team when we're thinking about how we're going to live out our promise to you, our clients, right, to help you manage your wealth wisely. One of the things that I talk about and I look at is demographics. Demographics are a dyed-in-the-wool, multi-generational thing to change. There are very few things that we know for certain about the future. And so I don't know what wise person I read or heard say this, but it's oftentimes better to focus on the things that won't change when you're thinking about, something in the future, whether it's trying to achieve a certain goal or managing wealth. So what do we know about the demographics of the BRICS countries? Well, first and foremost, their birth rates are significantly higher than the rest of Western civilization. So they have a growing population base. The average age of a citizen in those countries is significantly younger than most of Western Europe, than what I would call westernized Asia. So think Singapore, Hong Kong, Japan, Korea, right? And also younger than the US. So from an economic force, you have countries that are emerging in terms of their middle class and their ability to spend money on discretionary things. You have a young workforce that's hungry, that's looking for ways to make money. And so they have some demographic things in their favor or economic forces in their favor when you look at demographics. So, India would be a great example of this. They're now the world's most populous country. When you look at some of their capabilities that they have because of globalization and a lot of the offshoring the US has done, right? They have a very burgeoning and it's not new, but quite growing, technology sector, right? So how are BRICS going to factor in? Well, I think as Western civilization continues to age and our birth rates continue to fall, we're going to struggle with significant amounts of debt. And how do we pay those, promises that we've made to the baby boomer generations and older? The BRICS countries, on the other hand, are facing a problem on the opposite end of the coin, which is how do they create enough jobs and economic activity so that their people don't starve, become disenfranchised, start a revolution, right? Things like this. Now, I'm being a little bit broad here because I think that looks different in Russia than it does in Brazil or India or China, right? So that there's definitely some differences across those countries in terms of their homogeneity, how they approach their economies, like what Russia is structured as right now. Interestingly enough, because they've been under sanctions and ostracized from the US and Western banking system, they've actually become pretty resilient internally from what I can read and see in terms of their currency and manufacturing capabilities. But by and large, if we think about just demographics, they're going to be a force in the future because they have the human bodies, right? Whether jobs are going to move there because when there's a supply-demand imbalance, right? There's more people that need a job in India than there are people in the US in total, right? Which means there's more of one category than the other. So that supply-demand imbalance will probably keep their wages suppressed for a while, which means it'll be less expensive for things to be produced there. Obviously, this is where the tariff conversation comes into play. So I think you have that. The other thing that you have with BRICS, and then I'll toss it to Josh and he can add. So demographics would be one for me. The other one would be looking at natural resources, right? So all of those countries in that group of the BRICS, right? Now, the US has a lot of natural resources as well. We have significant regulations sometimes that impede our use of them. That's a debate for another day, whether that's a good or bad thing. But a lot of those countries don't have those regulations and safeguards in place. And so their ability to leverage their natural resources, I think, is a little bit less expensive. And things like rare earth minerals in China, some of the rare earth stuff and the elements needed for, say, nuclear power that Russia has, those are definitely things that they control that the future is going to need more of. So those would be two things, demographics for me and natural resources. Josh, how about you?
Yeah, I mean, I was going to kind of hit the same points. I mean, although China is a unique one in terms of the demographics, where actually because of their one-child mandates that they had a couple of decades ago, they're actually in I think a population crisis where they actually are now like promoting like, hey, everyone have more babies. But all the other countries, are seeing massive population growth. But I would echo I think it can't be understated how important a lot of the BRICS nations are going to be, and also the leverage they're going to have going forward, which I think they're starting to see this as well, which is part of why I think they're positioning for, moving away from the US dollar a little bit when it comes to natural resources. But I think with all the move to like EV vehicles, as well as, big data centers, those rare earth metals like copper, lithium, all those things are not as abundant, or I think we've discovered some stores here in the US, but are hugely abundant elsewhere across the globe, like South America, Africa, Asia, that we don't have a lot of in the US, but they're also pretty environmentally devastating to extract a lot of those rare earth metals. And kind of your point, Ron, like we have a lot of restrictions on getting a lot of those things out of the ground in the US, which is going to make it pretty hard to do here. So I think the BRIC nations are going to start seeing the amount of leverage they have because of those natural resources with the developing Western world, and just our kind of hunger for those things. So it's going to be interesting, but I think we're still a ways off from, them having, significant influence outside of maybe China and Russia. But I think something that we could definitely see.
Yeah, and the continued debate, the BRICS thing to bring up, Tim, is really great in light of the conversation about tariffs. That's probably going to be maybe a dominant narrative for the indeterminate future. When a global company, I'll use Apple, right? And we're a Mac shop, so I'm not speaking bad about them. I've got a Mac Studio and an iPad and an iPhone and earbuds all sitting here, but they manufacture most of their phones and their products overseas. So you have India, China, Vietnam, places like this. When you look at the average cost of living and living wage in those countries relative to the US, even if the US slaps a 200% tariff on the price of the good coming into the United States, it still costs a fraction for a company to manufacture it there. So what's happening with the demographic piece is when you have a young population base that's hungry for work, right? And they're willing to work at a lower wage, you're going to see, and this is where favorite economists of mine like Frederick Bastiat and Milton Friedman and the Austrian school guys, they would say that's just a natural tendency then for businesses and capital to flow to those places because there's a supply-demand imbalance. So I think that's probably a dominant narrative that's likely to continue for a while. And that's going to play into some of the world tension. So those countries by measures of wealth are far, far, far below the US and Japan and Great Britain and places like this. But they have blue sky, right? Which is why most of the large companies in the S&P 500 as well also have significant presence in those countries, and they invest heavily there, not just because they want to manufacture their goods and services less expensive, but because they also want to make sure that they're selling into those markets, right? It's future consumers. Okay, really good questions there. Feel free if anybody has thoughts and you want to toss them, we'll keep going. There's a question from Jeff. Are the TIPS, Treasury Inflation Protected Securities, in Tranche 1 still safe? I'll take this one again, and then I'll let Josh add some commentary or thoughts. Safe is absolute. Safer is the correct word. Not picking on this here because I know exactly what you mean. We use them interchangeably sometimes in the office, but this is really important. Safe means that there's absolutely no risk to it. Are there risks to US Treasuries? Sure. When we talk about a big item like the decoupling of the US dollar from, as a reserve currency, when we think about the collapse of empires, right? Those types of things still present some risk to the US and our debt. But maybe a more important thing to talk about from a risk standpoint is just the impact of what's going on in the markets and investor sentiment relative to people wanting to put money in and pull money out of US Treasuries. So what we've seen this year, right, is that US Treasuries are still safer than most other places that you can put money. Holding cash, especially in the last few months, a lot of the institutions that were paying a higher yield have pulled that down some. Now there still are good places to go and get, 3.5% to 4.25% yield on cash and savings. But if you've been just sitting in cash, you've been losing to inflation. If we sit in TIPS, what we're doing is we're hedging against the risk of inflation. So it's a safer place to be when we're in an inflationary environment. But you're going to see market value fluctuations as the yield on those goes up and down, right? As the underlying yield on US Treasury debt goes up and down, you're going to see some price changes to that security. So TIPS are safer as a hedge against inflation than cash. If I need to write a check tomorrow to pay my electric bill, the TIPS might be a little bit more risky than just holding it in cash. So it's a relative measure here. When we're holding assets in Tranche 1, that is the next or the projected 3 years of income that you need into the future. Okay, so there should be, right, some form of cash in your accounts, whether it's a high yield savings account that you have or some cash here at Lifeworks. And there likely also is something that is exposure to TIPS and or some other US Treasury debt. So there should be a mix in there. So yes, TIPS are still safer than most risk assets. They are probably more risky in terms of short-term price changes than just holding cash or a CD in an interest-bearing account. And we think each client situation is slightly different. Sometimes there's some commonalities there in Tranche 1, but there's some slight differences. So someone might have more cash because they have a short-term larger expenditure coming up than they would have TIPS or other fixed income. And the converse might be true. Somebody might not need much cash this year because they're just kind of winding down work, going into part-time, and next year they need to start spending more. So they might have more allocated to TIPS than someone else. So hopefully that answers your question. Josh, any thoughts there on TIPS being safer than risk assets? Or did I cover it just fine?
Yeah, nothing to add there. I mean, I think you nailed it. The biggest risk is if you need to sell it, because once you invest anything, like the timing becomes everything, just because everything has risk once you put your money into it. So it's just a matter of, all right, if I need it tomorrow and it was 2 weeks ago when all that volatility was happening, well, yeah, then it's not a very safe asset. But if I'm buying a TIP and holding it to maturity, it could be a very safe asset. So it's all relative, kind of like you were mentioning. So, but one thing I was going to point out on the BRICS to kind of put a bow on that too, is in terms of like putting into perspective the, influence there still. I mean, just to throw this out there, I mean, Apple speaking of Apple as like a company, is worth more than the entire GDP of Russia. And so, I mean, that can kind of put into context the influence, even with like the natural resources and stuff that they have there. Right now, the influence is still pretty minimal.
Yeah, that's a great point. In fact, many of the companies in the S&P 500, their valuations are higher than a majority of the entire GDP of countries around the world. Just to put that kind of size and scope into play, back to the question about dollar dominance and things like this, the trend could reverse, right? The US could decline, but we're talking decades and decades to get back to where there's some, where there could even be close to parity in terms of US valued assets relative to the world. All right, we got a question from Sean, and it's a big one. Josh and I have shared opinions on this. I'm actually going to let him take this one first. We'll reverse it. I'll see his answer. I'll add some color commentary. Here's the question, Josh, from Sean. With China tariff war potentially causing a combination of new credit risk in the bond market plus inflation where rising rates becomes a need, what alternative do you suggest for the income allocation in a client's portfolio to avoid another down year for fixed income like in 2022?
That is a very great question. Yeah, kind of like we were just alluding to a minute ago with like the tips conversation. I mean, I think a lot of it is timing. And so, I mean, cash during volatile times can be an important thing, but then you have to counterbalance the inflation side of the equation. And one of the best hedges against inflation historically has been long-term holding equities. Just because as prices and stuff change globally, kind of like we were talking about with the Big Mac index, well, that obviously impacts the prices of things, which then impact the earnings of different companies, which then impact the stock price of those companies. So you have sort of a natural hedge against inflation when you own equities. So having equity portion of your portfolio, and then even if, like, say, a bond portfolio, it's timed to the point where, hey, it's just not a good time to get income from a bond portfolio, for example, or like it's just not a good time to hold bonds or whatever the case may be. You can strategically time selling of equities and treat it almost like income as well. And that's kind of one of the thoughts behind the different tranche system we use, is that, if you time it right, you can sell equities and actually get preferential tax treatment over getting it as like just an interest or dividends. It's actually cheaper tax wise to sell an appreciated investment. So by having that inflation hedge, you just time when you sell it, and you can kind of treat those sells as income, as an alternative to holding bonds. Not saying not hold bonds, again, because like we were saying with tips, there can be a very strategic place to still having that. It's just something to keep a close eye on, of whether that is still a fit or not, or like how much cash you should have relative if there's volatility in the bond markets and things like that may increase your need for more cash in the short term just to offset some of those variables. But overall, I think the premise still stays strong that like there's a strong case for battling all these different variables by owning long-term equities, with some hedges like gold and Bitcoin and things in there as well, and having some non-correlated assets. But overall, I think the premise that we preach all the time still holds strong, even with all the variables going on. Anything, Ron, you want to add to that?
No, I think that the one other point, and we made a shift in 2022, right? So previous to that we were doing a lot of what we would call hedged equity strategies or hedged equity portfolios. Oops, I got my screen up on the wrong side. Let me get this out of here so it doesn't distract us. Lifeworks still does a lot of hedged equity portfolios for our clients. It's something our team has actually been talking about too, in terms of the use case for it. So expect to hear more from us in the coming months about the potential to maybe reduce some fixed income positions and move into protected portfolios, what we call it a hedged equity structure. We started doing that in 18, 19, 20. We were doing it all the way through 2022. The premise back then was interest rates were zero, basically. And when interest rates go up, the value of bonds goes down, right? There's that inverse relationship between the yield and the price. And so our thesis at the time was interest rates are zero bound. There's really nowhere for interest rates to go but up, because if interest rates would have gone negative on US debt, there's a whole another economic theory that would have played out that would have been disastrous for, the world. But as interest rates went back up in 2022, that rapid escalation, right? We saw bond portfolios absolutely crater. We also saw stock portfolios take it on the chin. So to Josh's point earlier about the 60-40 not being the autopilot portfolio that a lot of traditional firms or advisors and still pundits talk about, just got destroyed. So we're thoughtful of this. We're very mindful. Interest rates are not back to historical long-term averages. So interest rates still have some room to push up. There is a lot of uncertainty out there, and we're not trying to forecast. As everybody knows, we're not in that game. But it might be that what we'll start doing is slowly moving, or I would say more strategically moving away from some of our fixed income positions to some hedging strategies. There is some cost to this. When we do a hedging strategy for a client, like if we own equities and then we put some options in place to provide downside protection, we have to buy those options from the market. Right, so I'll just give a quick example, and then I'm going to move on to the next question, because I know we're running short on time. Let's just say that we have $1 million portfolio, and we want to establish today a 10% drawdown floor, meaning we're okay with the value of those equities going from $1 million to 900,000. Okay, to go out into the market and to buy options to create that floor, it might cost us 3 to 5% of the total portfolio value. Right. So if we have $1 million portfolio and we put $50,000 into options that create downside protection, true downside protection, right? What then happens is if the market goes up and we have a positive return on the equities, the options that we've just purchased expire worthless. Okay, so market goes up 10%, right? The equities are would have been worth 1.1 million had we not hedged them. Now they're worth something like 1.05, 1.03, something like this, because the cost of the options slowed down the growth. So there's always a trade-off. There's no free lunch, right? Dividend portfolios come up quite frequently as well. We'll cover that in another time because that can be a long-form discussion. But from an income perspective, the correct way to think about income in retirement is to think about it in the form of timing and tranches, what we do, not to think about it in the form of taking yield off of a portfolio. There are many, many, many clients who have gone broke chasing yield on a portfolio, meaning trying to get higher and higher yields because that's how they're timing their income. The right way to set up income in retirement is to own the asset that has the right volatility for when you need to spend it. So again, money I'm spending next month to pay the utility bill, that should be cash. Money I'm spending at the end of this year to pay my property taxes, that should be cash, right? Money I'm spending 3 years from now, well, those should probably be something like tips, right? Or fairly liquid, low volatility types of fixed income things. Now, year 4 through 10, that intermediate time period is where it starts to get tricky because we don't want to lose to inflation, right? But at the same time, we don't want to just be completely unexposed in the market. So we've done this a lot before for our clients. Right now, we still think that the fixed income space, well, it feels a little bit more choppy just because of the amount of news and some of the rapid swings we've had, right? Imagine for a moment that I'm going to say Trump gets his way. Again, not being political here, and Powell lowers rates. Well, if the Fed lowers rates and all things else are equal, meaning there's not a nuclear war that's been started or something like this, just if he lowers rates, what do you think will happen in the fixed income markets? Well, when interest rates go down, the value of bonds go up, right? So we're in a space right now where the political pressure on the Fed is to lower interest rates. The political pressure, by the way, on our new Secretary of the Treasury is also to lower interest rates because he has $38 trillion of debt and he has a significant chunk of that has to get refinanced this year. So there are other things at play here that probably are going to be driving interest rates. And again, we're not in the forecasting game, but I'll end this here and I'll move to my quick presentation on risk management by saying this is something we're very thoughtful of. Again, we define risk as not having the money that needs to be there for you to spend it to live the life you want. Greatest risk is inflation. Market volatility is only a risk if you're not allocating, and everybody here by definition would already be allocating their assets correctly, right? If we're not allocating our assets based off when we need to spend it, right? So we'll talk more about this in the coming months around options for having different types of downside protection, right? Hedging and option strategies is one. We still do them for a fair number of clients for very specific reasons. We might be doing a little bit more of that for everybody in the future where it makes sense and reducing some of the fixed income portfolio. But right now, political pressure and political headwinds are on the Fed to lower interest rates. If that's the case, the value goes up. Fed could raise interest rates, right? The reverse could be true. Fed starts raising interest rates, equities are going to drop as well. So again, all bets are off there. Okay, so let's just jump real quick to risk management. Q2 of every year, our focus is taxes and risk management. When I built LifeWorks, why did I put those together? Well, they were two of my least favorite subjects. When I left Northwestern Mutual to start LifeWorks, I looked at my co-founder and I said, I'm never signing another insurance application for a client again. I absolutely abhor having to deal with insurance and all things risk management. I don't want to do it. Now, we know the importance of it, so I just share that tongue-in-cheek slightly here, right? But risk management in our industry, guys, is generally contextualized as an insurance product. Why? Because it gives the advisor, the firm, or Wall Street, or whatever you want to put on it, the ability to sell you a product for a commission. So several years ago, I started evaluating, what do I think the greatest risks are going to be to our clients from a risk management standpoint? One, we live in a very litigious society, right? And so protecting yourself from frivolous lawsuits by having umbrella insurance policies is something we recommend to all of our clients, right? Being thoughtful about who owns what assets, proper estate planning, right? To make it in the event that somebody slips, trips, and falls while delivering your DoorDash to your house and sues you for $5 million, right? These are the things that happen more and more. So I'm going to talk just today, one section of risk management on cybersecurity, digital privacy, and I'm going to give two resources for how we are helping our clients navigate this. There is no perfect science to this, right? But no, this isn't going to be a conversation about insurance products. We will have another one of those coming up probably in the next month or so before we end Q2, because I think it's important, especially when we start thinking about health care options, long-term care options, Medicare planning. It's a really important subject. But today I'm just going to talk a little bit about cybersecurity. Now, I'm not going to claim to be an expert here, other than LifeWorks has been building our own software and involved in software development engineering now since 2019. We also have had to go through different types of regulatory audits where our policies and procedures around our own cybersecurity are often highlighted. We also have cybersecurity insurance. Just getting that as a business, especially in our field, required a significant amount of work, lots of audits, lots of things we had to go through to it. Okay, but when I talk about cybersecurity, these are some things that I've taken from our work with Mark Hurley, who's the CEO and founder of Digital Privacy and Protection. It's one of the companies we partner with to do this work for our clients. From his stuff, from my reading, and from watching, here are some of the most common cyber attacks. And I listed number one first. This is a pet peeve of mine in my family. And I unfortunately still hear of and see far too many people that know that they should have better password management policies and procedures that don't. So probably number one common cyber attacks is going after compromised passwords. Number two is device and smart home like vulnerabilities. So think Ring doorbells, Wi-Fi enabled refrigerators, garage door openers, heaters. light fixtures. In our home remodel right now, we've just gone through like, do we want our light switches to be connected to our Wi-Fi? And I'm like, if we're so lazy as to we can't get up off the couch and flip a light switch, like, right? But it's a thing, right? You put a light bulb in now, and there's a 50-50 chance that it's actually a smart light bulb, which is pretty cool. You can dim the lights while you're sitting by. So those are a big one. Malware and social engineering, I'm not going to cover that today. There's a lot of stuff we can talk about there about phishing attacks and things. Those are real. Deep fakes and voice cloning, not going to spend much time here today. Just know that this is something where the current state of AI, if you have videos of your family or yourself on your social profiles, and your social profile isn't locked down to just known friends, like if you have public facing videos of you out there, the ability to clone your voice and your image now can be done in less than a minute. And it's so good, the average person would never know the difference, and your family member might not either. So for me, as most of you guys maybe know or don't know, there is a ton of videos on YouTube and different social things where I've given live talks, trainings, things like this. And so there is a monstrous amount of Ron talking out there, probably more than the world needs. But the ability for somebody to do a deep fake or a clone of my voice and my image for a video call or a voice call is real. If you think, well, that's not me, Ron, well, then I would say go to your social profile, whether you're a Meta user, Facebook, Instagram, or whatever, and say, do I have videos of me and my family members, birthday party, singing, like something like this, and they're not locked down and protected, meaning anybody in the public can get it. By the way, most of the LLMs, the large language models, the technology underneath AI was built by scraping data off the social platforms. I just say that because that's what they were built to do. Okay, so deepfakes and voice cloning, and then public networks and charging stations. For those of you that travel, if you're plugging your devices in to a public charging station, there are USB data blockers that I would suggest you have, that you put in front of your plug and then you plug it in. It blocks any firmware or hardware that might have been installed in those charging stations to try and compromise your device. I'm not going to talk about 3 through 5 today. I will be releasing our white paper and some more resources on this in the next couple weeks here, so just watch your email. There'll be a video with it too. Let's talk about one of my pet peeves on my team, also with my family, password strength. Now, this is a table that's created by a company called Hive Systems. They're a cybersecurity specialist. They basically go through and say, using current technology, how fast could you crack the average person's password? Okay. So if you look on the left top of this, if it's numbers only, so if, by the way, your iPhone device is like a 4-digit number, like ... that would apply here. Okay. If your password to get into your device, laptop, iPad, iPhone, whatever, is 4 digits, 5 digits, 6 digits, and it's numbers only, it can instantly be cracked. Right? If it's 8 numbers, it's about 30 seconds. Okay. Now, as you move to the right on here, where you have numbers, uppercase, lowercase letters, symbols, etc., what you see is it starts taking longer and longer for a brute force attack to compromise, your password. Meaning somebody gets your device, right, and they want to try and crack it and get into all your stuff. Okay. If you're not inside of a corporation potentially that has the ability to like wipe devices remotely, there is some of this, and I know iOS devices because I use them. You can have it set up to where you can wipe one of your devices remotely if it's compromised. I'm not a PC user and I'm not an Android user, so I can't speak to how to do that on those, but I'm sure you can. But if you start thinking about your passwords, right, numbers, uppercase, lowercase letters, symbols, etc., as you move to the right on the top of this, and then you move to the, down the number of characters, what you start seeing is it takes longer and longer and longer, even for modern technology, to crack it. Now, this is not applying a supercomputer structure like a ChatGPT to passwords. All of these listed on here, if you applied truly like an OpenAI or one of the LLM's entire computer force to it, they would be cracking these, even the most sophisticated passwords, quite rapidly. So the technology is coming and this isn't getting better. So what do? Well, one of the things that I would say, and this I see regularly, is people will use the same password over and over again. I get it. I have multiple devices. I have a boatload of sensitive softwares and access points that I have as a CEO of Lifeworks. And it can be frustrating having different passwords, two-factor authentication, and multiple security sign-in steps just for me to access, your data here on my systems. Okay. So this is right from Hive. This is not from Ron Bullis. This is not from Lifeworks. I want you to see this. So somebody asked the question on their blog, okay, what if my password was stolen, or I use simple words, or I reuse it between sites? I want you to focus that last piece there, reusing it between sites. Here's the table now. If you use the same password over and over and over again, or some combination, if it's like the first dog you ever loved and your kid's birthday and whatever your combination is, and you're like, well, I just reverse it, it's game over. So in data breaches, what oftentimes hackers are going for is they're looking for the password hashes, right? So they hash passwords using different encryption methods. That's like way beyond my pay grade. But if a data breach has happened, right, and your password might be out there in the dark web from another vendor, and it might have been some really ridiculously dumb things like your, ilovepets.com, and you created a picture of you and your favorite pet, and you just forgot and used the same password. I'm actually using a real scenario here that happened in my family. And then you have your financial accounts and you just, use the same password. You essentially have no protection. So when we think about risk management, and I get asked a lot, like, what do you do, Ron? Well, I have two-factor authentication. I'll walk you guys through exactly what I do. It can be cumbersome, but the first and best thing I think everybody should do is you should use a password manager, not a keychain, or not the Chrome password manager or Safari password manager, right? Or the Windows-based password manager, but a third-party encrypted password management system, okay? I use LastPass. We also recommend Keeper to our clients. There's a handful of them that are very highly regarded. What do you do with a password manager? Well, every one of my passwords for every one of my sign-ons, even something as dumb as ilovepets or whatever.com, it's a unique 18-digit or 18-character plus password. My password for my sign-ins on things that are mission critical are in the 40+ digits. And then there's 2 layers of security I have to go through for that. But for your everyday, like sign into your iPhone, sign into your laptop, your Wi-Fi password at your home, right? Every single one of those passwords should be unique. Every single one of them should be at least 12 digits. My target is to go for 18. And I use my password manager to automatically create the password, save it into my system. Now it's saved and encrypted on the web with a one-way token. And I have to use a fairly significant and strong password to unlock it. But what it allows me to do is if one service I'm using gets compromised, it doesn't put the rest of my accounts potentially in jeopardy. So most of us, I think, when we're thinking about our financial logins, probably are pretty good with our passwords. Device and smart home, right, things, your Wi-Fi enabled refrigerator, your Wi-Fi enabled light bulb, your Ring doorbell, things like this, okay? These are very frequently targets because people don't think about the importance of making sure you have the right structure and setup for them. So when I think about what keeps me up at night when I'm thinking about our clients' accounts and risk management, one is the litigious society we live in, and I can't do anything about that. We can help with umbrella policies and think about how we make sure if something happens, you're prepared. But the cybersecurity one, I think, is real, and it's not getting better. As we move closer towards quantum computing becoming a real thing, like everything we use for password management and encryption goes out the window anyway. So this is like a train that's moving. My recommendation is get on it. So first thing here, every device in your home and every sign-on should have a unique password. Now, as we're talking about a home real quick, you should have a sophisticated or a robust enough Wi-Fi router at home that you can make multiple Wi-Fi networks. So I'm just going to tell you what I do. Somebody else might be more sophisticated and post a better example here. I not only have a guest network for when friends or my kids' friends come over and they have a device, I have a separate Wi-Fi network I call Things, and it's completely isolated. So it's my, doorbell, my garage door opener, right? My TV. It's the things in my house that are supposed to be smart. My thermostat connected to the internet, right? If for whatever reason one of those items was breached somehow, they can't get to my main network that my laptop, my wife's laptop, right, and our main browsing happens. It's a very simple thing to do, and we have separate passwords and security protocols. So that's one way of addressing that. So on the password side, though, use a password manager. The objective of risk management as it pertains to cybersecurity is to make yourself a hardened target. That's a quote right from Mark Hurley, who I think is really, really brilliant in this space. If you do the basic things really well, right? So different password for every sign-on. Every sign-on that I have that offers me the opportunity for two-factor authentication, I accept. I use a code generator on my cell phone. So if I want to log into lifeworksadvisors.com and see my accounts, I don't only have to plug in my password, I have to plug in a random 6-digit code that's refreshed every 30 seconds. So even if my password's compromised, somebody gets into my device, they try and log into my systems. If they don't have my code generator, they can't access my stuff. It's very secure, right? I change our passwords frequently. So your password management and how you approach these things is probably going to be one of the best preventative ways that you can protect yourself and your family. I change my passwords. I think we mandate them at LifeWorks every 30 days. I change my personal passwords pretty frequently, probably not at 30 days, but like every 90 days. Another reason to use a password manager, this is risk management, but at a different level, is I'm just going to kill my screen here, is from an estate planning perspective. So something that maybe you've talked about with your spouse, your loved ones, your kids, maybe not. I see a lot of families skipping this, is who can get into your phone or your bank accounts and things like this if you're in the hospital and you can't speak, right? So my password management system, I have certain accounts that my wife has access to, right? And she's also set up to be able to be like the recovery person and trusted contact. So in the event that I'm dead, she doesn't lose access to all of my digital assets. And I'm not talking Bitcoin and stuff like that. I'm talking things like pictures, memories, my writing, note takers that I use, then access to our checking accounts and things like this. So password management, and then also starting to think about how you are prepared to share those passwords with the trustee of your trust, your spouse, trusted contact, things like this. In the event of death, some type of accident or incapacitation. That's something our advisors will be talking about more and more with all of our clients in Q4, is how we're going to tie some of these things together. Because if something happens to you and your spouse has a power of attorney, yeah, they can show up to the custodian or the bank and they'll go through a legal process, and between 2 to 4 weeks later, likely they'll have control of the account and they can spend money. But if they need to access something tomorrow, right, generally financial institutions take a very methodical approach to approving powers of attorney, especially for financial matters. So having a password management system set up where with your spouse or a trusted contact, your partner, they'll have the ability to potentially recover your passwords, access information on your cell phone, your devices. It's something that gets overlooked as part of estate planning. I would view it as an important part of risk management. Okay, so I don't want to take us too far down that, but I just want to share a couple of things. So first thing that you could do is you can follow some basic best practices on your own. And I'm just going to riff them here real quick. One, use a password management system and make sure you're not reusing the same passwords. If you have smart devices in your home, consider putting them on a different Wi-Fi network and have a reasonably strong password for both of your Wi-Fi networks. If you haven't changed your Wi-Fi network's password in years, I was going through this as I was doing a home renovation. I'm like, oh, we've essentially been using the same Wi-Fi password on one of our personal networks for like a year now, right? Change it frequently, okay? Third thing that you can do, this one doesn't relate to passwords. Everybody should go to the 3 major credit repositories, TransUnion, Equifax, and Experian. And you should have your credit report locked. They have to do this for free. they will try and sell you memberships. You don't need to buy a membership, right? But a locked credit report means that if somebody does get your social security number, your date of birth, compromises your identity, and tries to open a debt account in your name, or tries to open an investment account, most institutions also look at the credit bureaus. It's not a credit pull, but it's an identity verification. That will show up and they'll be blocked from viewing anything, and that person won't be able to open that debt account or transact business. It's simple, takes like 10 minutes to do. It's a little bit of a pain in the butt. And if you go to buy a car or get some financing and you forget to unlock your credit, generally you just have to go do that, and then they'll reprocess the credit report. So if you have adult children, especially if they're maybe not thinking about their credit yet, or they're still in college, get those credit reports locked down. Oftentimes kids and adult children that haven't kind of entered the working force and using their social security number a lot become targets for identity theft because nobody's looking at their credit. Right. But for you personally and your spouse, locking your credit down, that would be number 3. Pretty quick and easy thing to do. And I'll just stop there because we're over time quite significantly. If anybody has any questions on this, happy to chat. I know we're well over, so if you have to jump, thank you for being here. As always, you hear me say this, we are honored and we love getting to serve you and your family. We hope that these live streams are informative and interesting discussions, and we plan on doing more of them in the future. As I said at the beginning of this, we're going to break apart the market and economic update because that tends to be something everybody's interested in. And then these educational components and how-tos that are tied to our annual planning calendar. So Q2's risk management, expect to see more stuff from us over the next 6 weeks, 12 weeks, almost just under 12 weeks, as we're running through the rest of Q2 here around things like cybersecurity, digital privacy, long-term care, risk management from a liability protection. Somebody, again, slip, trips, and falls and sues you, things like that. We're going to be talking about that in your meetings with your advisors and producing more. So if you got to jump, thank you for being here. Have a great rest of your week. If you want to hang out, Josh and I will stick around for a few more, answer some questions pertaining to BRICS, the market, hedging, interest rate, cybersecurity, or any other interesting topic. You're welcome, Lex. Go ahead, Francis. No worries.
So I can put on the Jeopardy music while you type.
Do, 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 do. I mentioned Jeopardy the other day, and my kids didn't know what it was. I was like, man, I'm turning to my parents. I'm dating myself. The company that we recommend for helping with cybersecurity. I'll post the URL here. They are fantastic. Their price is $35 per month. You get 24/7 access to a personal cybersecurity team. They're US based. They're not a 1-800 call center. They will spend a couple hours with you in onboarding, locking down all your devices, taking you through all the security settings that you need, both on your social profiles, your web browsers, and your devices. Highly recommend using them. Here, I'm posting it in the chat. I'll make sure we send it out in the notes. There's the landing page. They only provide their services through wealth management firms. So it's a custom private group that does this just for wealth management firms. They'll walk you through like locking your credit report, setting up a password manager. There's a lot of things they do, but I think the biggest one is you have somebody to hand hold you through that, and then you get 24/7 access. They have a bunch of other things they do. They get you set up with a private email, VPN, things like that. So check them out. They are not salespeople, and their process is very thorough. So don't go into it expecting that it's like push a button, it'll take 10 minutes and whiz bangery, you're all done. This is a personal, customized cybersecurity and digital privacy onboarding that they do. They're great folks and definitely worth checking out. All right, Francis, let's see. I've seen recent commercials for locking your home title as well. Josh, do you have any knowledge or thoughts on that? I have heard of this. This is not something I'm an expert in.
I would agree. I mean, I think it's something that's I don't know the mechanisms for actually doing that, but I would think it's a good idea. If it's something possible, I wouldn't necessarily go through a third-party institution potentially for that. Like I'd maybe work like if you have an estate attorney or someone that you're working with, doing it through them as opposed to like a specific service. I mean, oftentimes those services are scams. But I have seen this actually happen like a week ago. I've seen like just titles get messed up inadvertently trying to put them in trusts where like I saw someone's that had basically somehow put like their neighbor's property in their trust, just through like an typo on the trust file, like the deed filing. Like so, whenever you update like your property and put it in like a trust for estate planning purposes, you essentially update the property deed with the county or the state. And just through a typo that happened, and so that's having to get pulled back. So to me, that was definitely something that is worth protecting if it was that easy for that to happen. Again, I don't think that's mechanisms yet for doing that, but I would imagine working with like an estate attorney or something, that's who you'd want to go to get that done.
I just did a quick cursory search, and I think that title lock is essentially a marketing thing. I posted a link to the FTC, not always saying the FTC gets everything right, but they're definitely talking about how like a lock on your credit bureau, where it means it's frozen and it can't be accessed, is very different from a title lock. It looks like quick search there is that title lock are just services that will monitor your public deeds records. I don't know what they charge. I haven't looked into this, but most of the public deeds records can be searched online relatively easily. So depending on like whether you want to do it yourself, like once every 30 days or something like that. So I would say if you're going into something like that, just eyes wide open, because it's not a lock. It just appears to be like a monitoring service, and they're kind of using that term from a marketing perspective. It might still be valuable. I'm not taking a position on that, but that's what I just found in quick search. And we do a lot with real estate. I have a fair amount of background, and I know Josh does as well. A lot of our clients have investment real estate and things like this. Mortgage fraud and title insurance. So when you bought your house too, you also purchased title insurance, which protects you from any of the previous title issues going back. I don't know that it warrants like trying to buy insurance here in this regards, because if somebody was trying to like steal the title to your house for something, I think probably the most common one, or the one I could think of, would be them trying to use your property to like take out a loan. Right? So there would be some lien on your property without you signing for it. And there's a whole litany of other things that would have to be happening along the way, including your credit report being accessed. So I think maybe still locking down your credit reports with the 3 repositories might be also one of the valuable steps to take.
Okay, thank you. I think Home Title Lock probably was the one that I saw the commercial for.
Yep. Yeah, great question, by the way. And I think it could be a very valuable service. My property is in my trust. I have a mortgage on it, so maybe it makes my property a little bit less attractive to somebody to try and do something with my deed. Okay,
yeah, I mean, that's definitely an argument for putting it in the trust too, because it at least keeps some separation between you as an individual and your property and stuff as well.
Okay, sure.
Yeah, just because, especially because you can name your trust whatever you want. So obviously, if you put your full name on there, it can be easier to tie. But definitely an argument for keeping it in trust titling to keep at least some separation.
All right, I appreciate that.
Yep, great question. All right, last couple minutes here. Anybody with any final thoughts, questions, comments? We'll sign off here in just a minute.
Hey, Ron, it's Sean.
Hey, Sean.
I'm sure you're aware I'm not a fan of the bucket tranche strategy, but when are you guys going to get into the covered call writing hedged equity stuff?
Great question. So we are doing hedged equities, and we'll be offering more of it to clients and advisors with some very specific things. I'm not a fan, and our investment team is not a fan of covered call writing. it generates ordinary income taxes and it caps the upside of equities. So if somebody is owning equities and they're looking for income, I think there's potentially better ways to do it. But I understand the question. So yeah, if you want to, you can shoot me an email and we can talk about what some of the options are from a downside protection hedging strategy. But generally speaking, the calls that are generating the most premium or income are on the companies that probably have the most upside. So, there's a lot of talk about selling covered calls as like free income, but there's no free lunch. It's the least tax efficient way of taking income off a portfolio. And it's also essentially a forecasting of where you expect the future to be, right? But downside protection using options is something that I think is going to be, we'll probably be using and doing some more with it in the coming quarters.
Inside an IRA, though, you're matching the tax, right? It's ordinary income inside of a account that's going to be taxed at ordinary income, tax deferred until that. So you guys are cool with the ETFs that I have, like JEPQ, JEPI, stuff like that?
I don't know the specific details about each one of those ticker symbols, but what I'd say is, again, if somebody's holding an equity and they're holding an equity because it's a hedge against inflation, they're wanting to have long-term growth on it. It's counterintuitive to then sell a call that limits the upside. So if you look historically at where call premium is generally written and created, and you look back at the last, let's say, 5 years, even recent history, a lot of the call strikes, the equities would have blown past that, and somebody would have been essentially missing out on significant growth on those assets. So there's a couple of things that happen, right? So for people that aren't super familiar with this, when you sell a call and you own the underlying security, what it means is you're basically telling somebody, look, you give me money today and I'll lock in a price at which I'll sell you this stock. So if we just say we have some random stock that's trading at $100 and I sell a call at 110, right? I tell the person who buys the call from me, look, if this stock goes to 200, you can still come back and buy it from me for $110, right? You're essentially like giving them the option to lock in their price. So when you look at a couple of things that can happen in an IRA where we don't have tax considerations, you can ignore tax impact of the call premium and the forced sale. If somebody's doing this in a taxable account, you wind up with two things that happen, especially in a market that's volatile and bounces up quickly. One, right? You wind up with the ordinary income tax on the call premium. But two, if you get called away, you now are recognizing potentially capital gains, maybe losses, but generally capital gains. So you're having double taxing here. But our thing, if somebody's using covered calls to generate income, again, there's lots of different reasons why people might pursue a nuance to part of their portfolio's income strategy. There's lots of people that sell covered calls for income. That's a tactical piece inside of a portfolio. The correct way to still do it, and when I say correct, there is academic research. This is not Ron Bullis, but the correct way to be a long-term investor and manage income appropriately is to follow what's called a liability-driven investment methodology, LDI. There are Nobel laureates that have written about this. If you look back at how endowments, long-term pension funds, sovereign wealth funds, early conglomerates of co-investing together, owning the asset that's appropriate for when you need to turn it into income is the correct way to be oriented as a long-term investor, right? Now, you might own something that's in the long-term growth category, right? So the 10 plus year dollars into the future, and maybe you decide to sell some covered calls on those or somewhere else in the portfolio because you do want to generate some income. There could be some reasons somebody does that, right? It's just like sometimes people buy income producing real estate, and there are other people that buy real estate that is not cash flow positive, but has growth potential to it. And, again, that's a nuance inside of that asset class. But our position is if you're holding an equity, you're holding it because we're expecting to have long-term growth on it, right? So capping that long-term growth, but then still having the risk exposure to that asset going to zero sometimes can be a nonsensical position. But all that to say, I digress. There are valid reasons for selling covered calls. We just don't think it's the right way to orient an income for somebody's income in retirement. The right way is to still own the correct asset that has the right volatility for when we need to spend the money.
Okay. I'll shoot you an email.
Yeah, do that. Happy to have a conversation off this about it. All right, everybody, Josh and I are going to sign off from here. It was great seeing all of you. Again, from everybody at Lifeworks, thank you for trusting us. We love what we do. We are grateful to have you and your family as clients, and be watching for an email in the next few days here with some of this recording, and then over the next couple weeks as it pertains to, while we're in Q2, things on taxes and risk management. So from Grand Rapids, see y'all later.